If you're buying your first home, one of the biggest questions you're going to face is, should you use an FHA loan or a conventional loan? Most first time buyers assume FHA is the best option, but that's not always true. In fact, choosing the wrong loan program can cost you thousands of dollars over time in mortgage insurance premium and interest. So in this video, I'm going to break down the real differences between FHA and conventional loans. Which one is easier to qualify for, which one has the lower payment, and when one loan is clearly better than the other. I'm also going to clear up some confusion around 3% down conventional loans, because there are some important rules that many buyers don't realize. Let's get into it. Let's start with FHA. FHA stands for Federal Housing Administration. Now, here's something many people misunderstand. FHA does not lend you the money. Instead, FHA insures the loan for the lender, which reduces the lender's risk. Because of that protection, lenders are able to approve borrowers who have lower credit scores, higher debt-to-income ratios, smaller down payments. That's why FHA loans are extremely popular with first-time homebuyers. FHA down payment requirements. FHA requires a minimum down payment of 3.5%. So if you're buying a home for $400,000, your down payment would be about $14,000. One of the biggest advantages of FHA is that the 3.5% down payment works for properties with up to 4 units. That means FHA can be used for single-family homes, duplexes, 3 families, and 4-unit properties, as long as the borrower lives in one of the units as the primary residence. This is one of the reasons FHA is often used by buyers who want to house hack and live in one unit while renting out the others. Now let's talk about the downside of FHA. Mortgage insurance. FHA requires 2 types of mortgage insurance. Upfront mortgage insurance. This is 1.75% of the loan amount. Example, you purchase a home for $400,000. You put 3.5% down. You have a loan amount of $386,000. The upfront FHA mortgage insurance is about $6,755. Most buyers roll this into the loan instead of paying it out of pocket. FHA also requires monthly mortgage insurance payments. For most loans today, it's around 0.55% annually. Example, the loan amount of $386, multiply that by 0.55%, divided by 12, and that equals $175 per month. And here's the big catch. If you put less than 10% down, that mortgage insurance lasts for the life of the loan. The only way to remove it later is to refinance into a conventional loan. Now let's talk about conventional loans. Conventional loans are backed by Fannie Mae and Freddie Mac. Unlike FHA, they are not government-insured loans. Because of this, conventional loans usually require higher credit scores, stronger borrower profiles, lower debt ratios. But here's something that surprises a lot of buyers. You can buy a home with as little as 3% down using a conventional loan. However, there are specific rules attached to that 3% program. The 3% down conventional program is designed specifically for first-time homebuyers. A first-time homebuyer means someone has not owned a home in the past 3 years, but there are additional requirements that many people don't realize. First, the borrower must complete a home buyer's education course before closing. These courses are typically online and designed to help buyers understand the mortgage process, budgeting for home ownership, how to manage housing costs. Second, the program does not allow non-occupant co-signers. That means a family member cannot co-sign the loan if they are not living in the home. Third, the 3% down conventional program is only available for single-family homes. So the property must be a 1-unit home. This program cannot be used for 2, 3, or 4 family properties. That's a key difference between FHA and conventional. because FHA allows 3.5% down for 1 to 4 unit properties, while the 3% conventional option is limited to a single family home only. Conventional loans also have mortgage insurance. This is called PMI, private mortgage insurance. But there is a major advantage compared to FHA. Conventional mortgage insurance does not last forever. Once your loan reaches 80% of the home's value, the PMI can be removed. This can happen through paying down the loan balance or the home increasing in value. Eventually, that monthly insurance payment disappears completely. Now let's compare credit score requirements. FHA credit scores is much more forgiving. Typical approvals can happen around a 580 credit score, 600 credit score, 620. That's why FHA is commonly used by buyers who are still building their credit profile. Conventional credit scores. Conventional loans usually require at least a 620 credit score, but the real advantage comes with stronger credit. 620 score equals higher interest rate. 680 score, but a little bit better pricing. 720 score and higher, best pricing. Borrowers with higher credit scores often benefit more from conventional loans. Real payment comparison. Let's look at an example. A home price of $400,000. With the FHA scenario of 3.5% down, the loan amount is about $386,000. Monthly FHA mortgage insurance about $175. Estimate monthly payment, including taxes and insurance, is around $3,000 per month, depending on rates and taxes. A conventional scenario with a down payment of 3%, that loan amount is about $388,000. PMI might be around $120 per month, depending on credit. Estimated monthly payment is around $2,850 to $2,950 per month. And remember, eventually that PMI goes away completely. When FHA is the better option, FHA tends to work best for buyers who have lower credit scores, higher debt-to-income ratios, limited savings. It's also the better option for buyers who want to purchase a multi-unit property with a small down payment, because FHA allows 3.5% down up to 4 units. When conventional loan is the better option. Conventional loans usually make more sense when borrowers have credit scores of 680 or higher, stable income, lower debt ratios. In those situations, mortgage insurance is cheaper, mortgage insurance eventually disappears, and the long-term cost of the loan is often lower. Biggest mistake first-time buyers make. The biggest mistake I see buyers make is assuming that FHA is always the best loan for first-time buyers. But that's not always the case. Many buyers actually qualify for conventional loans with better long-term costs. The only way to know for sure is to run both loan options side by side. If you're thinking about buying a home and you're not sure whether FHA or conventional is the better option, the best thing you can do is run a custom comparison based on your credit score, income, and purchase price, because the right answer is different for every buyer. If you found this video helpful, make sure to like the video, subscribe to the channel, and drop your questions in the comments. And if you're planning to buy a home soon, I'm always happy to help walk through the numbers. Thanks for watching.